The FASB recently issued an exposure draft relating to the accounting for premiums on the purchase of callable debt securities. The exposure draft was issued to address constituents' concerns that the existing amortization period for the premiums do not represent the economics of the transaction. Instead of recognizing a lower amount of interest income over a longer period of time with a loss to earnings once the call is exercised, which occurs under current U.S. GAAP, the proposal would amortize the premiums over a shorter period of time. My name is Danielle Imperial, and I'm joined by Mahesh Naraswamy, and we're going to spend a couple minutes talking about the recently issued exposure draft.
Thanks, Danielle, for that high-level update. I'm just curious about a couple of things. It sounded to me that the scope of this guidance is pretty narrow. Can you elaborate a bit more on what the scope is? And also, I'm curious as to how the accounting would work on, for example, if an entity purchased a security at a discount. Would you be able to shed some light on that as well?
Sure. Thanks, Mahesh. The scope is actually pretty broad, or broad than one may initially think. It was originally started or raised by stakeholders in response to the accounting for municipal bonds, because they make up the majority of the market, which is the callable market. But essentially, it would actually apply to all callable debt securities that are purchased at a premium. The proposal only addresses the accounting for premiums. So current U.S. GAAP, where it's codified, includes both premiums and discounts. The board decided only to make the amendment to premiums such that the amortization for premiums would go to the first call date. However, for discounts, it would continue to be until the maturity date. The exposure draft was issued in the third quarter with comment periods due November 28th. Although the effective date has not been determined, an entity would record the guidance through a cumulative effect adjustment to retained earnings as of the beginning of the first period in which it is applied. And in the period of adoption, an entity would provide the disclosures about a change in accounting principle. Thank you for joining the podcast on accounting for interest income associated with the purchase of callable debt securities.